Dividend increases are often welcomed with excitement, but they demand careful scrutiny. DM Wenceslao's latest raise is no exception. On March 12, 2026, the board approved a cash dividend of 0.10 per share, up from 0.095 pesos last year. It's a modest bump, but it speaks volumes. Management is signaling confidence in the company's resilience and capacity to reward shareholders. What makes this increase truly defensible is its foundation, a robust, lease-driven business model. Over the past 2 years, recurring revenues have taken center stage. In fiscal year 2024, core net income climbed 10% to 1.8 billion pesos, and recurring rental income surged 27%, now accounting for nearly 9/10 of total revenue. For income investors, this is critical. Reliable rent collections, not just one-time land sales, are what give dividends credibility and staying power. Performance in 2025 remains steady. By the third quarter, DMW had booked 2.88 billion pesos in revenues and 1.4 billion pesos in net profit, further consolidating its rental-driven earnings. Commercial and ancillary rentals strengthened, and residential revenues lifted as new developments neared completion. The company's rental base appears solid, with recurring income still dominating. Financially, DMW hasn't had to stretch itself. As of September 2025, the firm held 4.51 billion pesos in cash, outpacing debt by a comfortable margin. Key ratios, including low debt to equity and ample liquidity, underscore its flexibility to pursue growth while maintaining dividends. In an industry where over-leveraging often undermines shareholder returns, DMW's balance sheet inspires genuine comfort. Looking ahead, the company's lease portfolio offers runway. Minimum future lease collections total nearly 50 billion pesos, with much of it extending beyond 5 years. Occupancy is strong, and new projects like Asiana Plaza Phase 1, as well as PACE-accredited space, will potentially deepen the income stream. Yet the bullish case faces a challenge: cash flow. Despite strong reported profits, net cash from operations in 2025 was thin, raising questions about dividend sustainability beyond balance sheet strength. Receivables are rising, and the flow from earnings to cash isn't as robust as one might hope. The next stage of dividend growth depends not just on healthy profits, but on improved cash conversion. DMW's dividend is far from peaking. The board is still paying out a modest slice of earnings, with healthy reserves and a strong balance sheet. But every future increase must be justified by stronger operating cash flow. Investors should watch this metric closely. For now, the dividend hike is sensible and backed by recurring income, low leverage, and a promising pipeline. Sustaining this trajectory will require that rental operations continue to deliver, and that cash truly follows earnings. Thoughtful optimism remains, but wise investors will keep their eyes on the flow beneath the surface.